Good evening, ladies and gentlemen. This is Clueless Trading Frank. This is a very important free webinar on the second week, or I should say the week after, of the most volatile market events that we have encountered ever on a statistical basis. Markets will begin in a couple of hours on Monday, 9:30 a.m. Eastern Standard Time, New York time. This free webinar is being held on the 11th of February 2018, approximately 8:42 p.m. Eastern Standard Time. The session will be recorded and uploaded to the YouTube Clueless Trading YouTube channel for free viewing by all members, as well as any other interested traders, would-be investors, or whoever that may be. Feel free to pass the word along. All the videos, all the free videos that are posted on the Clueless Trading YouTube channel are available for viewing by anyone who has access to the internet. Extremely valuable insights into U.S. financial markets and global events on the financial side, and I hope that you all benefit from reviewing them before the market begins tomorrow morning, Monday, February 12th. Full disclosure, this is purely for financial education and not for any solicitation or advice, and we shall begin. So I'm going to start off with some broad statements, which all of you already know, obviously. What we encountered since last Friday, not this past Friday, but the Friday prior to that, the exact date being the 2nd of February, was unprecedented, monumental, extremely, no words can describe it, volatile, and throughout the whole entire period, Clueless Trading has been engaged with members, walking them through every single precision tactical level on the downside and the upside, and what measures needed to be taken along the way. It has been difficult. There is no question about it. At the same time, we have had some monster winners on earnings. We have had some monster winners on intraday trades, both on high beta momentum stocks, as well as the S&P 500, the Russell 2000, the Nasdaq 100. And the bottom line is that despite all the pains and suffering of trying to game and trade a very random, and the key word is extremely fast, in nanoseconds, in minutes, in human terms, movements in the market, we have been there to guide all our members. And that's the best we can offer as a trading service. And I hope all of you respect that. On that note, the culprits behind this monumental and unprecedented movements in the market, thousands of points, in aggregate, thousands of points back and forth. But like I said, thousands of points from the top to the bottom. Hopefully that is a short-term bottom, what it looks like right now, certainly. And we're going to go through that on the charts. What you're seeing behind you is a picture of the actual market, which is S&P 500. All the way from the depths of when the S&P 500 on March 9, 2009 hit 666 down here, and where we are today. The visual representation of this chart speaks volumes, and all of you can see that very clearly in the form of structured trend lines that have been put in place by myself. So the main culprit behind the overall market was a complete implosion, a massive explosion, I should say, and an implosion of prices due to a macro tactical trade generated by a large number of hedge funds. I have put multiple articles in detail for all of you to understand what really happened. It's always important to do an autopsy on, and a full dissection an examination of the events, a very large macro trade that has been put in place months and months in a row, which was shorting the VIX. The media calls it, Wall Street calls it the vol trade. It has nothing to do with volume. It has to do with volatility. The vol trade is basically going short the VIX while going long both equities as well as going long government bonds, government bond prices. So when government bond yields started to spike up, which we discussed in detail, and I explained the forecast of that in my TNX videocast, extremely important for all of you to go review it if you haven't seen that yet, which explained that if bond prices spike dramatically and sharply higher, not necessarily in actual terms of value, but in the rate of change, how quickly it moves higher, then the markets will get unnerved short term. And what happened was short term. It was 1 week or 8 days. Okay, that's short term. So that caused that big macro trade on shorting volatility, shorting the VIX, being long the markets. And I don't think hedge funds were that long the market, to be honest with you. They were more shorting the VIX. They were long government U.S. Treasury bonds. And when that decoupled, things just went nuts. The amount of money involved in that particular macro trade is unknown. I don't know, at least. But I do know it was in hundreds of billions of dollars, if not maybe $1 trillion. I don't think it's $1 trillion, but hundreds of billions of dollars. So when that unraveled in fits and starts, it caused a massive, monumental, unheard of forced margin sellouts, where the prices of government bonds, as they dropped sharply and yields rose sharply from the mid 2s to almost little less than 3%. They still haven't reached 3%. Government 10-year bonds are still at 2.82%. I'm going to pull that chart up right now. TNX weekly. They're going out. There we go. And I did say in in my original video that this was a cup and handle, and there was the breakout of the handle, this being the cup, and that we were heading towards that 3.1% or so. Let me put it. There you go. 3.039%. But we would find, I also did say, that this was the first pattern completion right here from back in 2014, 2018. And you can start to see, if you look carefully, that was the first pattern completion right there and right there. And you can start to see the development of a red doji candle, which might turn out to be, and which probably will happen in high probability, these forecasts have been right year over year, a minor pullback on government bond deals towards the 2.7% or so. So that'll be a cup, the first pattern. This is pattern 1. This is the full pattern completion. So most likely what's going to happen over the next couple of weeks is we are going to, or much sooner because things are happening a lot quicker, what would normally take months and months now are happening within days and hours. You get a 10 plus 12% correction type of move on the overall Dow Jones Industrial Average. It's happening within a week. In the old days, years ago, it would normally take a few weeks, if not months. So now it's compressed. And it's happening quicker for a simple reason. Machines drive the market. This is a completely black box. That's simply a term for high-frequency trading computers. It's an algorithmic high-frequency trading market. So things are happening, the unraveling or the movements higher are happening very, very quickly. So get used to it. I've been talking about this for years. Now, most of you are starting to accept it. That's the reason why tactical trading, despite all types of markets, bull or bear, does pay the bills. It is difficult, and net, the week was a net loss week, but in between, very powerful winners. And going forward, there will be lots of powerful winners, both in the market and individual stocks, selected stocks that I present out there. So tactical trading and understanding charts have become not only critically important, it has become mandatory. There's no more, oh, I hope the market goes higher. I think the market will go higher. I think that's going to happen. I think Trump is going to do this. It doesn't matter. You have to follow the levels. If you have to understand the charts, basic and advanced. If you're advanced, then you're going to fare a lot better. But the whole purpose of my webinars and the time that I spend in educating my members is simply to further that purpose, that you have to become robotic in the way you look at things, whether you like it or not. And the ones who don't, they quit. And that's okay. Trading and making money in these type of volatile markets, which have been going on for years. This is not the only time we've encountered volatility. This has been the most extreme and the most dramatic. But the markets have been volatile all the way from 2009. We have had 10+% corrections 4 times since 2009. The numbers are bigger because it's law of numbers. We are coming off 26,000 plus. And when we were having 10% corrections before, we were coming off maybe 20,000 or 18,000 Dow. So the numbers were smaller, but the percentage was the same. So emotional traders, unfortunately, and I speak the truth, so I'm not going to mince words, are not going to survive. They will quit, and that's fine. Because the lesser number of traders, like I've said many times in the chat room, the lesser number of traders who participate in this market, the better off for us. And the better opportunities you will have, both on the long and the short side. So consider yourself blessed and lucky that you're still engaged in the battle that we call trading, making money, and furthering our own lives. Okay? It's very simple. So going back to this 10-year bond, it looks like now that we have hit the first pattern completion, we are going to create a small handle that's going to pull back yields to about 2.7%, around that level. That will cause the markets on the other end, just to, if you want to see that as a market representation, to have a powerful reflex bounce, and this will fold out, this drama will fold over the next couple of weeks going into March. And the pullback in yields will create, there's a by the way, very, very important number coming out Wednesday. I believe it's a consumer price inflation, given the fact that the fear of a rising rates and rising inflation in the U.S. economy was the spark that started off the correction. And it is a correction. It is not a bear market. It's a correction. And as far as we can see so far, from what I see, and is very important on Wednesday. And I believe that it'll show somewhat lesser inflationary numbers. That's going to cause the 10-year government bond yield to pull back slightly. That'll cause the market to continue with its reflex bounce to levels that I've showed before and will show tonight. And that's what you guys got to trade into and make money. So that's basically it. Once it pulls back a bit, maybe 2.7, maybe a little bit lower. In fact, if one wants an exact number, I could possibly show one, because this is also a, these are the two levels that I'm looking at of a maximum drawdown. 3 levels. The first one being on the government bond side, a pullback to approximately, let me pull this out. Right there. So pull back to approximately, look on the right-hand side. You always have to move the decimal one to the left, 2.63%. Let me round it off, 2.64%. We have this yellow line here is a rising, it's a weekly chart. So it's cutting out a lot of the noise that happened on an intraday basis. The rising 5-week moving average, this yellow line, is at 2.708. So let's call it 2.71. So the first pullback could be 2.71%. If we start to see further talk of a less hawkish Fed, that means Fed which isn't talking about raising rates dramatically 4, 5, 6 times this year, maybe 2 or 3 times, then you're going to see a further pullback as the markets breathe a sigh of relief that we're not going to get into a runaway Fed rate hike cycle, which would not be that conducive to markets, to say the least, because that's going to raise the borrowing cost across the board for corporations, for individuals, for all of us, for mortgages, credit cards, auto loans, all the pillars of consumer spending. So that's not going to be necessarily good if there is if there is talk of more than 4, 5, or 6 rate hikes this year. Anyway, so if the Fed eases back a little bit, Jerome Powell is the head of the Federal Reserve right now. It's no longer Yellen, just in case you guys didn't realize that. He's a great gentleman, nominated by President Trump. Great choice. So if it talks down the market a little bit, talks down rates a little bit, the next level you can see here is the breakout of this neckline. That's approximately 2.63%. And on an extreme level, if rates really fall sharply, which would cause the market to move up on very quickly, because the rate hike fears would subside, then the most I believe that you can see here is if you want to look at this as a pattern, I'll show you. This is a complex head and shoulder, and that would be the level of around I would say this shoulder here first is 2.4%. I don't think rates go below 2.4%, and that would be a retest. You guys know this by now. That would be a retest of this downtrend line, which goes all the way back to 2008, and that would be right here, because these lines are all rising, right? So if they intersects this and retest the downtrend line, stocks do that. Remember, patterns and technical analysis can be applied to anything, any asset class that's in the market, whether it be cryptocurrencies, whether it be individual stocks, whether it be bond deals, you name it, right? You could do it with anything. So that's what we're doing here with the bond deals. So the most extreme pullback, if it does happen, is approximately in the 2.4 region. That will be a retest of this powerful downtrend line that was broken higher, the breakout that occurred starting around the 8th of January, right there. Okay, so that's your quick synopsis about the bond market, right? If we start to see a rapid move back towards the 3.04% level, which would be the first pattern completion, you can certainly expect the markets to get jittery again. It doesn't mean 1,000 point drops during the day and then a reversal of another 1,000 points, but that's a direct consequence of margin blowouts on the volatility short trades, the vol trade, and the XIV trade, but you will certainly see the market feeling jittery. Period. That's it. All right. So I don't want to get into this too much. Just giving you a little forecast and some predictive analysis of what might happen. All right. So let's move on. Let's hit the charts now. So now that you understand the background of what really happened overall, there has been a couple of other things you have to keep in mind. You don't go from a 10% correction to a 20% correction in the market in one go. You get a 10% correction, 12% correction like we saw intraday. You get a very sharp reversal higher. And if the market does want to go into a bear market, then you're going to hit those levels and then you're going to slide again. All right, that's just the way it works. Never in history has the market fallen, aside from that one day in October 19th, 1987, has the market lost more than 20% of its value in one day or in 1 week, in one go. All right, and after October 19th, 1987, that was really almost a one-day event. After that, the market just never looked back, just kept on going higher. So, you know, what more can you say? And that was the most dramatic day in the stock markets on a one-day basis. And we saw a couple of dramatic days just last week. So on the broader front, on the bullish front, the corporate earnings are very strong. They're coming out very strong. There's a lot of mergers and acquisitions activity. That means buyouts and things happening of mid and small companies by the larger ones, which is extremely healthy. Stock buybacks are going to commence very soon. Corporate buybacks, that's very good. There is fantastic feelings about the tax reform and corporate business-friendly policies by the Trump administrations. I've always said they've done a phenomenal job in doing that. And overall, it is very healthy with the cash positions corporations hold to buffer any type of massive drawdowns on the economy and things like that. Whichever the case, U.S. corporations are healthy. That's it. Earnings are very strong. They have good projections about their earnings. The global economy is strong. And barring any major financial crises, in specifically the biggest danger is China with their shadow banking. Don't want to get into it right now. The bottom line is the global economy is strong, and the recovery continues. So let's get into charts. That's what we do best, right? That's the economic backdrop that I just mentioned to you. So this is your long-term chart of the S&P 500. This is the all-time low, well, at least the multi-decade all-time low, October 9th, 2000 and, I'm sorry, March 9th, 2009. I was there on Wall Street. Remember that day. This was your housing crisis from 2007 to 2009. Markets basically came down, moved up, pulled back, then the massive crash that started in August of 2008, culminating into all-time lows of 666 on the, or 667 on the S&P 500. This is S&P 500, and we have and then a sharp move higher into 2010, a nice fat correction, 4 to 6%. Move higher into 2011 in July, a nice 10% type of correction, 8 to 10% type of correction. Move higher into 2012. And all this time, the market's kind of moving, you know, it still hasn't gone through. And I forgot to draw one very important line here. My fault. There you go. There you go. Okay. So this was October 2007. All this is going to tie out. I mean, have patience. So I'm tying all this in so you guys understand where we're coming from. So then the markets basically went up here. Let's start the journey here. 2012 had a quick correction. I believe this was around 4 to 5%. Then the market started to move higher into 2013. And finally, on April of 2013, right there, the markets finally break out. In my opinion, and many other Wall Street and outside forecasters said that, the real bull market started on April of 2013. I'm going to put 413. The reason being that till April of 2013, and this is October of 2007, so I'm going to put October 2007, the markets basically just recovered what they had lost. So it took a good solid 6 years from 2007, a little less than 6 years, till April of 2013 that we finally broke out. So if you want to, you know, sort of measure the market on an actual factual basis, not alternative facts, real facts, okay, then the rally that the bull market really started after it breached its October 2007 levels, and that was in April of 2013. So this bull market, if you want to look at it purely from a pure technical view, is 5 years old in April. Okay? Do you guys understand what I just said? Exita, Mike, Nick?
Yes, Frank.
Okay, good, good. Just putting things in perspective so we all understand what's going on. So from here to here, going into April, a little bit, we're going to go into April soon, it'll be 5 years. So you hear a lot that this bull market started in 2009. This was March of 2009. Okay, that was sort of the 9/11 of stock markets. We want to look at it that way. And so from a psychological standpoint, and it's not that we'll be going into 8 years. Okay, they'll celebrate it like that. When it goes down, March 9th coming up, they'll say, oh, look at that, it's the 8-year anniversary. It's always the number 8 of the bull market, blah blah blah. In my opinion, if you want to be a more advanced technical understanding of the markets, it is really 5 years going into April. So generally speaking, bull markets are not a function of time. They're a function of time and price and sentiment, all kinds of stuff, right? So if generally they say that a bull market lasts a decade. So if you want to look at a decade, this started off, if you want to look at it from a decade standpoint, if the bull market, let's say, started off in 2010, not from a technical standpoint, from a calendar standpoint, then you have a 10-year run that should take us into 2020, which basically is the next presidential cycle, right? There you go. So this bull market, in my opinion, and who am I to say, but just a keen and a passionate student of financial history and the way they work, and every day and every year I try to get better and better, I would say that you should be marking 2020 as the completion, overall completion of this decade-long cycle, because things do move in 10-year cycles. Okay, so bottom line is, if it's 2020, then we got 2 more years to go. And in between, there'll be vicious corrections and stuff, but that's when it really, gets up there. We don't want to go there yet. I'm just giving you sort of an idea of how to measure these big periods of time. So if it's 5 years going into April, it's not a long time. 5 years is nothing. And the 5 years started off on April of 2013. Okay, don't want to harp on that too late. Hey, Trent, welcome. You're not too late at all. It's Sunday evening. Everyone needs a little rest. R&R away from markets. You can always catch out the first part of this session when I upload it after it's over. So at this point, this is where we are. We also we were moving along. We had the big breakout, April. This was the from 2007. That was the big breakout. I'm measuring the start of the real bull market, the technical bull market, from this level. We went up. We had massive corrections along the way. 2015, 2016. This is the Brexit crisis. We have 2000 and the elections, right? The lows. And then President Trump wins and the market just takes off. So this channel that you're looking at, I've always called it the acceleration channel. The acceleration channel, which started off on right there on February of 2016, and then January of 2016. There were two big, hammer reversals. One was on January of 2016, and the second one was February of 2016. You can see that right there, right? So if you add and look how symmetrical and how perfect these lines match. So all I did was draw a channel. And guess what the market did this past week? It hit the bottom of the channel. And this chart is not the first time you're seeing this. I put this up a few times last week. And like I like to remind everyone again, you have to start focusing on these tactical charts in order to manage your money. What happened last week is not meaningless. It had a both psychological, a technical, and a monetary consequence on everyone's portfolios. But can that be brought back and make 3 or 4 times more? Absolutely. But in order for you to do that, it can't be just hope and like, oh, maybe it's going to jump or maybe it's going to do that. You have to become, no one can become a real robot. I'm not. Okay? I try to be as robotic as possible in the most critical times of the market. Engage with my members and try to keep them somewhat sane. But whatever you do, you got to look at these charts. Because these are speaking volumes. They're speaking money to your trading, to your investing. So this acceleration channel that kicked off in January and February of 2016, it engaged at once in November of 2016, right? That was elections right there. You guys didn't even show there, right? Right there, November of 2016. It engaged it, retested it, and it retested it again this Friday. Pretty amazing how these things work, right? Can't make these things up. So this level should, from a monthly and month by month and year by, going all the way back to 2007, should hold. And it doesn't mean it can be retested. I doubt it if it gets retested again. That's just my feeling as an experienced trader. But who knows? And if this breaks, then we know what the lower levels are. And that's around 2,500. Remember, this is the S&P 500. You don't have to do any mental conversions. Oh, it's E-minis. I got to add 5 points to arrive at the S&P. This is the actual S&P 500. So looking at the lower end of the channel, basically call it 2,500. 2,500 on the market, on the S&P 500, is on a monthly basis the most critical number, period. That's it. At one point, it looked like it was going to test lower than that, and it did at one point. Overnight, and remember, the S&P 500 chart doesn't show you overnight levels. The futures charts do. Whichever the case, you can see, you know what I'm talking about. If we do break 2,500, and remember, we closed at 2619. Let's call it 2620. If we drop 120 points to retest 2,500 again, that means it's another 600 to 700 plus points on the downside. Now, just about 2 weeks ago, we couldn't imagine 600-point kind of drops within a day, or forget a day, in 2 hours. Nowadays, it's just like, whoa, 600 points, we're going to bounce back 300. But these are abnormal times. And when things get abnormal, just the way the word suggests in English, abnormal, they are out of the ordinary. They're out of the normal. So abnormality does not remain in the constant. Okay? When people get, drink a few too many drinks, they started acting either too happy or too funny or too weird or too nasty, whatever. That's abnormal. When they come back to normal, once the hangover passes, that's normal. So the markets is in the process of returning to some sense of normality, because abnormality does not linger on for too long, unless the market's wholly mental, and that's a different story. So saying all that, from a psychological standpoint, 720 points here to retest this again is not abnormal, but at the same time, it's not normal. Can it happen? It sure can happen. It can happen as early as Wednesday when we get the inflation data at 8:30 in the morning. Or it can happen for any other reason. Could happen tomorrow. The infrastructure spending bill's coming out. If it doesn't really balance out that much too well, and if it's not worded right, the markets are going to freak out. Remember, we can't have $1.5–2 trillion worth of infrastructure spending. Who's going to pay for it? Tax receipts? Sure you can. But the bond market is going to spike higher for, that I explained the first part of the session. And that's going to cause the markets to drop again. Can we have a 600-point drop because it wasn't worded right and the infrastructure plan that's been delivered tomorrow by President Trump is not going to be taken well? Hey, it can happen. And we can retest the 2,500 again. But we shall see. I can't predict that part. So saying all that, this is a very important level. And if we break 2,500, then the next level that comes into play is, and the reason I drew this line is because this red line is the mid-Bollinger. This is a very wide Bollinger, right? Bollinger Band, which got stretched to the upside quite a bit because markets were doing so well and individual companies were doing so well. So the mid-Bollinger is somewhere around, we'll move this back, it's exactly at around 2,400, 2,410, right there. You can see that, S&P. This rising wedge, right? This rising wedge, you can see that, these two lines, this contracting, upward contracting triangle, if you want to look at it that way, also is somewhere around 2,360. So if we really create another huge monthly candle, hey, it can happen. I'm telling you right now. Okay, this full stochastics is still heading down. I don't see that turning around yet. This whole thing cannot control the overall thing in the market, but it's giving you some sort of idea. Back during the election time and prior to that during Brexit, we had a double bottom on the full stochastics. We're not seeing that yet. Here we were moving down, and then we created a double bottom somewhere in this level. This is pure technical analysis, okay? Right there, we created a double bottom. So this is still slipping down. So the downward pressure on the monthly basis is still there in the markets. So short term, it might be, the crazy selling might be over, but going on a monthly to monthly basis, it's not fully over yet, guys. All right? That doesn't turn me bearish, but I'm just being cautious. So you got to keep your trades close to the vest. Can't be hoping for, stocks just keep going higher and higher. Stocks are going to trade within a very tactical level, and I show that very clearly. And I trade it like that. So if you can't do that, then you might just want to get some long-term stuff and sit there, or I don't know what you can do. I'm sorry, I'm not here to I can't really tell you. All I can tell you is that this needs to stabilize, and this fast stochastics needs to show some sign on a longer-term basis of a turn. Okay, everyone understand that part? Yes, tomorrow's the infrastructure rollout. Yes, okay. So that's good. So that's one chart. Don't want to spend the whole evening on this one. So you can see that clearly. Now, if things really turn around and the pieces fall into place, and I have a lot of faith in the business aspects of the Trump administration and the people who are running the business side of the Trump administration and President Trump's ideas on how to change the regulation stuff, I think it's phenomenal. I think it's a new dawn for American business. I really do. Okay, so freeing them of the shackles of unnecessary regulations and stuff like that, which can propel a huge earnings growth. It can. So if that works, then this channel, and this is the hyper bullish thing going over into the year, and some people have suggested you don't get like every 2 weeks a 10% correction. I mean, come on. Generally, you get a 10% correction once a year. So let's assume that this was the 10–12% correction, and on individual stocks, the percentage was much bigger, right? We know that. Certain individual stocks. Then let's say this is it did its job. It did its 10-12% correction right in the month of February. Then in that case, based on this channel, we could go all the way up to 3,000 S&P. Remember, the bears came out of the woodwork and they said, we knew this was going to happen. Bull frigging crap, they knew this was going to happen. Okay? The bears told us that the market, it basically go from 666 on the S&P 500. Let me just put some facts on the ground. All the way down to 500. Go Google it. Okay? I was on Wall Street. Trust me, I know. I had to explain to all my clients, institutional and high net worth retail, what was going on. All right? All they kept on hearing, this was it. This was the big break. It was going to go to 500 S&P. And from 666, it went all the way up. In between, big corrections, mind you, as I've said. It's not like it's a one-way, little, like, oh, the market just went up and never looked back. Remember, lies can be propagated very easily by the other side. The big, I don't mean tactical shorts or bears. I mean the dogmatic bears, the George Soroses of the world. The, what's the guy's name? The guy who keeps on shorting Tesla? I forgot his name. I just had a memory, block for a minute. You know who I'm talking about. So there are these committed bears who I've always said kept people from making money. They just said, no, the market cannot go higher. Jim Chanos, thank you, Trent. Appreciate that. So Jim Chanos, always bearish on a lot of things. So they kept on telling us, no. So the bears basically, let's say a bear said, no, it can never go higher. Never put a single dollar in the market, and finally had this mini correction in the larger concept of things and saying, this is it. It's over. You decide with your own eyes and your brains by looking at this particular chart, going back to 2009, the multi-decade low in the market. If this really looks like the market's just going to go all the way down. It doesn't happen like that. Okay? So they can cherish this 1 week that they got. And even in that 1 week, we had massive reversals along the way, including Friday. And the next chart that I'm going to show, you guys will be like, whoa! Because I did say that was going to happen. And I reacted fast on my shorts that I did on the latter part of the day on Friday. And went long, hard. And of course I was long. Most of my other stuff was long because I was buying them low. I'm talking about the SPX short I'm talking about. So anyway, the next chart I'll show, and all of you will remember that I said that, and the word starts with a follow. And the next word is, you know what I'm talking about. So the bears will say, yeah, this is it. Well, if you are looking at it purely from a unbiased technical view, all we did was come down and test the lower end of this acceleration channel, which started right after Donald Trump's election. I'm sorry, that started in February of 2016, right? So the election was, I'm like losing track. The election was November 2016, right? Yes, okay. So yeah. So this was February of 2016. This was November of 2016. Yeah, good. So but this acceleration channel that broke out of this nice rising wedge, and this is basically an ascending triangle. I don't want to get into it too much. This is an ascending triangle. That's what ascending triangles look like this. And then the breakout. So this was a large ascending triangle. This one was 1, right? Oops. Just like that, broke out, and then the next one broke out here. So anyway, so all it did was retest that lower end of the acceleration channel, just the way it did here, and then reversed. Let's move on. The next chart I'm going to show you has to do with more short-term trading. All right? Does everyone remember, and everyone should remember, I said that one of the most important aspects, and this was my last video too, of any type of market volatility is what happens on the 4th day. which is known as the follow-through day. You guys remember that, right? The word follow-through? I talked about the word follow-through. Well, anyway, if you remember or not is not my issue. I'm just following through what I said. So the follow-through day is the fourth day, roughly. And I mentioned the follow-through day was going to be Friday or latest Monday. Well, guess what? The follow-through day was Friday. All right? So, because do the day count. Big crash, day 1, day 2, day 3, day 4. This was Friday. This is where we are right now with futures up 16, right there. Okay? So, the follow-through day worked. Now, you want to know an exact definition of follow-through day, which was a term coined by was it Jim O'Neill? William O'Neill, I'm sorry, who's one of the legendary investors and founder of Investor Business Daily. On the fourth day, the heavens shall open. And what happens on the fourth day? Whether it has to be an up day. Because if the follow-through day, which looked like it was going to be a down day till about late afternoon, when we're down about 600 points, if that followed through on the downside, then the follow-through day theory wouldn't work. But it didn't. The follow-through day starts from the day after the big crash. This was the big crash from a day count standpoint. Day 1, day 2, day 3, day 4. This was the big crash that came and tested the 2,500 level. Went actually lower after hours. Lower all the way down to 2,520. And I think it went lower than that. Then reversed hard. Day 1, day 2, day 3, day 4. And this is day 5 beginning in the world markets as we speak. Everyone understand this part? Yes? No? Questions? Okay, good. Because I thought of it later on today. I'm like, was Friday day 4? I'm like, geez, it was. That means a lot. Doesn't mean we're not going to have volatility tomorrow. Of course we will. But we established a massive, massive double bottom, hammer reversal, which are worth hundreds, if not 1,000 points, right? 1 and 2. So here's your line we have to watch for. I've already explained that. And regardless of what happens, if these lines are not breached, and we could have a triple retest, mind you. Like I said, if the infrastructure bill announcement tomorrow is not taken well and bond yields spike, we'll probably do that. And I'm going to be, doing those intraday short trades, but I'm not going to be sleeping on it. I'm not going to be like, oh yeah, that's it. This is it. I'm going to just keep on holding my puts. Now, here's a point of trade management. Whatever you do, try to, if you have profits on reversals and stuff, don't sit there watching it. Take it. Leave some in there. Otherwise, the market will take it away from you within 30 seconds, if not 15 seconds, if not 5 seconds. Am I right or wrong? I'm dead right. I know it because I'm a trader. Like you blink, they take it away from you on the long and the short side. On the short side, I managed to get out of almost 60%, 70% of my positions right at the bottom, right? Then the turn came. I hesitated, and the remainder 30% I had a loss because it happened just like that. And you guys know that. Because the machines just went into overdrive. So I looked at him, looking at it. Now it's going to do another quick one. No. Can't think. Just have to act. So saying all that, this is where we are. There's a gap fill here. Shown this several times. This gap was engaged once here when the market broke out in 2018. This was 2018. This gap was held a couple of days last week. We're going back into this gap. Okay, that's it. If things go the way it looks like right now, and this reflex bounce continues, and this gap will be filled probably by Wednesday. How about that? Or by Tuesday. So don't get too overexcited because the charts are just telling you there's a massive downtrend line here. So if we move from here after zigzagging like that a little bit, futures are up 16. You probably wake up in the morning, futures are down 16, right? I mean, we got to get used to this. But whichever the case, one way or the other, it probably wants to fill that gap and retest this downtrend line. That's 2681. So 2635, where we are right now in futures, we closed on the S&P 500 at 2620. So 2680, that's 60 points. 60 points in the S&P is roughly 400 points. 400 points. 360 to 400 points in the Dow. And we're going to go boom, straight into this massive downtrend line. And this is a big one. All right? This is the wall. All right? It's a wall. Now, if we break out of that, you know exactly what the levels are. This is a daily chart for swing traders. And I'm going to now go, next chart I'll show is the short-term one, the 1 hour chart. So bottom line is, if we break out of this, then we can possibly, again, remember, this is a big downtrend line. I'm going to make this thicker. You guys have to learn how to read the charts. I know many of you do. Many of you still, can't seem to understand these simple lines, but I'm sure you will. This markets will force you to become a tactical trader or a tactical, and it will force you to tactically understand the markets. Remember, we are forced to do things. That's when we do it, right? That's just human nature. If I gain 40 pounds, I'll be forced to really go to the gym, every single day. Now I'll probably go 1 or 2 days a week because I maintain my weight and, for what I am, I'm not overweight at all. Well, I'm overweight a little bit, maybe like 5 or 6 pounds. But if I'm all of a sudden I gain 50 pounds, I'll be forced to go to the gym. Well, this market will force all of you and all retail traders out there. And some of will be stubborn. They won't care. That's fine with us, because the less we have tactical and technical traders who understand the way I put my charts out and stuff, it's the better off for us. Trust me, because they'll be blown out. We get hurt, but they'll be blown out repeatedly, because it's all about hope and emotions, and all of them trying to be analysts, as I say, not analysts, analysts about macroeconomic theory and all that good stuff. Garbage. So follow the charts, all right? Follow the charts. So this level here gets engaged about 400 points higher. I would see how the market reacts. Now, it's possible that we do this. This is where we were on Friday. This is where we are now. Let's say we pull back a little bit. Let's say we pull back here to 2,600. 2,600 would be like 100, 150 points. First thing tomorrow morning. Would you be surprised? I don't think so. Do I think all of that forced margin sellouts are all over? What the heck do I know? I don't completely think so. So I think any big 300, 400, 100, 200 point rally, initially they'll slam it because they're using higher prices to recover the monies. You understand that part, right? A margin clerk sitting out there who has to sell, let's say, $10 million worth of margin calls for one client, one hedge fund, will look for higher prices on a Google or a Apple or a Priceline or a Netflix or an Amazon, looking at some primary names. They use them as ATMs. To pull money. Because when the Googles of the world, the Amazons of the world, I'm talking the big cap $30, $40 movers, move like that, they're like, hit it. Now we can get out of that position and that $10 million margin call can be satisfied. Because when these stocks are collapsing, they can't recover the 10 million because that hedge fund probably has a bunch of Google and Apple and stuff in their portfolios. So the margin clerks are using these rapid rises intraday, and you saw that with your own eyes last week, to slam it. Boom, comes a big sell program. What, something changed within like 2 o'clock and 3 o'clock? No, the only thing that changed was the margin clerks basically taking their money off the and satisfying the margin calls and doing the forced sellouts. Now, Friday could have been a short-term bottom for technical reasons I'm explaining. It also could be that they just wanted to close out and go flat on their books. And people who are in business understand that they want to even out their books on the credit and debit side, on the margin side, and say that's it. So when the market started to rally, they're like, slam it. And I told our members that too in the chat room. You ready for another 400-point drop? It's coming. And it came within 30 minutes. And I was actually buying puts. And then I finally suggested to you guys too. I don't like to really suggest these type of 10, 15-minute type of things because, first of all, most people are comatose. They're shocked. And what's the use? Why confuse them more? But the ones who are using my charts to trade these things, they're doing well. Not easy, but they're doing fine. Even though there's a bunch of the long positions are down. They're making money intraday on these type of trades. So the key is that we're going to watch this. And if we break out, we know what the levels are. This is your big uptrend line that started on August of 2017, right there. That uptrend line is key. So mark this number in your head, 2727 on the S&P 500 futures. That's roughly about 2730, 2732 on the S&P 500. 2732, that's about 115 points from where we closed at. 113 points where we closed at on Friday. The 113 S&P points, so that's roughly about 600 plus points on the Dow. If we breach higher above that, that's, look, it's never, they say, it's not, what's the word they use a lot in the media? Is it the green light yet to buy stocks? Like, what are you talking about? The green light to buy stocks is here. Okay? So they'll be like, oh, is it safe enough to go? Yeah, safe, right. Yeah, as if the market's ever safe. I mean, come on. So throw out those words, all right? Safety is how you determine and quantify your risk. That's safety. That's how I tell myself. It's never safe. Well, is it safe to buy stocks when I keep on saying we're going to have a correction? How many of my videos have said this correction was coming? Did I know exactly it was going to be this dramatic? No. But can I stand behind my forecasting that I said we're going to get a 1,000, 2,000 point drop? I didn't think it was going to happen in a frigging week. It's great that it happened in a frigging week instead of being stretched out for months. But is it safe to keep on, doing kabooms and keeping on chasing things? No, absolutely not. So this is the most unsafe period. Even though we still had a little bit of room to move, as I had shown, if it had kept on going. But I did say this was coming. And I did say in my videos, by the way, just if I want to stand behind what I said, that it was going to happen in February. Well, it happened in February, guys. So bottom line is, this is where I look at it from safety standpoint, where the prices are coming to me and I'm not chasing it. I like chasing momentum stocks, when they're moving fast and furious, but I like it more buying when the prices are coming to me. And they are on a relative basis cheap. Think about that for a minute. That's called mental calibration. That's how you got to look at things. All right? So when the market breaks out over this uptrend line, that's when the really dogmatic shorts, who basically, let's say, shorted here, for example, they and probably haven't covered here yet. Who knows? I don't know. Okay? They're going to just start freaking out. So this is the bear kill zone if the market enters that. All right? And you can see that from the chart. So if the market recaptures back the trend line, the uptrend line that started in August of 2000 and what did I say? August of 2016, right there. August of 2017. Let's not go too far. August of 2017, when all of you were a few months younger. Okay. So bottom line is that if we recaptured that uptrend line, and when I'm showing this chart, not every 15 minutes, let's say I show this, a couple of times a week as we move along. Watch this. If we break above that, that means there's going to be a rapid rise. And that rapid rise doesn't mean we're going to make a new high. Well, who knows? But it at least means that this level where the market totally collapsed, all right, we are going to hit that 28-25 level again. Does everyone understand this very simple but highly methodical way of looking at the markets? If you have any questions, feel free to ask. That's what I'm here for. Okay, good. Thanks, Trent. So we've covered this part. Now let's go into the short-term stuff, the one that gives us the impulses to go for our adult diapers, right? All of us. Is your short-term chart. So this is your short-term chart of the market. This is, you can trade this all day long. Got to be quick. You can trade this. All right. So this was the tactical trading range that I showed. These charts have been posted on a real-time basis a couple of times a day. And guess what? The tactical trading range held. Simple. All right. So here's your low, 25.28. Remember, these are the E-minis. So 25.28 is roughly, let's call it about 25.30 on the S&P 500. We already saw that. Or 25.19 on the S&P 500. I'll call it, this is SPX 2520. E-minis. I'm sorry, this is SPX 2530. Let's not get bogged down with just numbers. But this is it. So there's your trading box. I don't have much to say. There's your trading box. If things go right, you're going to go to the upper end of the trading box, which is basically 27.27, where the breakdown really started. Anybody who says, oh, the market, we knew this was going to happen, so far, it's a piece of, One thing I detest are liars who basically propagate lies. I do. In people, in the media, in anybody. State the facts, whether you like them or not. Now, we all have a tendency to state facts which serve our own needs, right? Our own biases. But when you blatantly come out and you say like, yes, it was just a one-way straight down. How many times have you heard that in the media? They're complete liars. This was not a one-way straight down. Since the beginning of the week, we were trading in a channel. We were even going higher. And the markets did this. That's straight down? I rest my case. So, saying all that, this is your tactical trading roadmap. Now, you don't need to necessarily use this to trade SPX and the SPYs and stuff like that, which you certainly can, to a high level of profitability and accuracy. You use this to see whether or not you need to lower a position size. You use this chart to see whether or not you want to get into something and hold it. It gives you what you need to see, that if the markets are going to break down completely, you need to bail, or whether we need to hold and cost average down, bring those option cost averages down, because you're going to see a big fat move off the lower level. Stocks like Google. Take a guess. At the low of the day, during the flush, right there, does anyone remember where Google was? And Google is one of my favorite tech stocks right now in the market. So, where was Google? Yeah, Google actually at one point went below 1,000. Google was 1,003. No, Google actually, yeah, you're close. Google went to 997 within a couple of minutes. And I was alerting throughout this period. Within a couple of minutes, and then within 20-25 minutes, Google went up $54 from that $1,000 mark. 997 is basically 1,000, whatever. 997, probably a split second. That's actual print, by the way, on the code screen. Probably it was there for like 1/100th of a second. Anyway, it closed. It went to 1051.72. I blinked because I bought some cheap calls. I blinked, the stock was up 20. I blink again, it was up 30, up 36. So when you listen to the liars out there, and I find it very, disturbing, but wait, life is not fair, man. Life is disturbing. And through chaos comes order. It's up to you how you look at it. You look at life as chaos, your whole life will be chaotic. You look at life as chaos, and then comes order, and you do what you need to do to fix everything, your responsibilities, your troubles, and everything through efficiency, through hard work, through methodical planning. Then that's order. That's the way I look at life. Some people would like to look at life as chaos. Well, in that case, why don't you shoot yourself up with meth and go hang out there? You know, I don't know. So I'm just being straightforward. So you hear the liars out there who basically say, "Oh yeah, it was just like that. You know, I just knew it." This is garbage. And this chart itself throws that, proves that on a visual basis. So key is that we're dealing with volatility. Volatility is on the rise. Get used to volatility. That's it. I've always said that, and now you guys believe it. All right. So this is it. This is your trading roadmap for the active trader, or even a non-active trader. This is your trading range, and the trading range is basically 25.28 and 27.27, 27.30. So that's 200 points. Believe it or not, this could be a weekly trading range. 200 points. We are halfway there right now. You can see that. You're halfway there as we speak tonight. A little bit more than halfway from the bottom. So this is 200 points, right? And 200 times roughly 6, because one S&P point is roughly 6 Dow points. That's a rough conversion. You are talking about 1,200 points is this tactical trading range. So once you know all this stuff, you feel a little bit more assured about what's going on. Am I right or wrong? It doesn't have to make you feel good, because you got a cost average down on something you bought and all that good stuff, but at least you know where you stand. So if anyone disagrees with me, feel free to say, "Hey, no, I don't feel assured about these type of knowing what the lows and the highs are." I don't think anyone's going to say that to me. I mean, how can you? So that's it. This chart is critical. If we break out, the downtrend lines is a big fat red one here. If we break out over this one, this is your channel that the stock market was trading in from the highs. Okay, see this. This is very easy on the eyes. Okay, this is a very methodical structural chart. 1 second. I'm going to walk people through this, because many of you, unfortunately, because of the absolute thunderstorm in the markets back and forth, have somewhat been comatose. So hopefully I'll be a surgical technical doctor and sort of walk you through this, so you can at least come back to your senses a little bit. Wakey time. So here's your Fibonacci retracements. This is the highs in the market. This is the highs in the market right here at the 2,900 level or so. This is your lows in the market right here at the 25.28 level. I'm going to do a simple percentage. We're at 29.79. Let's call it 28.80. We dropped to 25.28. That's 352 S&P points. We dropped 12.2%, ladies and gentlemen, from high to low in 1 week. We dropped 12.2%. Okay, that's 12.2%. Now, all Fibonacci retracements do work. So 50% retracement is right here. That's at this. So this is a big channel. 1 second. It's still a downtrending channel. Okay, so there's your big downtrending channel, which was attempting to, it was basically moving in between the channel, and the close of the fifth, it looked like it was going to basically head towards, head towards and break them. And this is the mid channel right there. I'm going to make that a dotted line. Okay, so there's your mid channel right there, and so it looked like it was going to break over the mid channel, but then came the whopping, the big move overnight. Nothing we could do. It's overnight. And so at this point, this chart, I'm just walking you through it so you know how to read this, because this is really simple. These are just downtrend lines and channels. That's all it is. And then, of course, keeping an eye on the stochastics as they get overbought, whether they're going to move sideways, whether they dip quickly lower, because this is a 1 hour chart. So it moves quite rapidly. That's why it's a trading chart. So we would like to see on the bullish end, on the long end, the market break this big fat red line, the downtrend line that's over 2643. You can do that. And by the way, this investing.com is free. Any of you who are not using investing.com as one of your chart platforms to mimic this all these structured charts that I draw, or some of these structured charts that I draw on investing.com, is making a fatal mistake. This is free. Go to investing.com, put your email, and you have this. And you can replicate this chart. Anybody who's not doing it, I have nothing to say. I have nothing to say. It is a fatal error. You got to do it. It's an amazing platform. I use this. I use Thinkorswim. I use my very advanced quad algo HFT charts, the bar charts. And these are the three main platforms that I use. But this is free. So if you didn't have Thinkorswim, you're trading through E-Trade and stuff, fine. Even though I highly suggest that you have access to Thinkorswim charts, but use this. It's very easy on the eye to see everything. So anyway, so you got one downtrend line here. We have broken that overnight. We're up 16 S&P points. You can see that, okay? The next one, which is a big one, right there, comes into play at around 2640, more like around 2660. How about that? 2650. If we go over this blue arrow is telling you that's when you get the big short squeeze, because now you have entered this channel. Remember, this is the channel right there. So if you enter the channel, you automatically get a automatic short squeeze. You react automatically. You look at my alerts. You can act before me. In fact, my smart traders, they act before me. Then they see my alerts coming through because they know how to read these things. They're acting on their own. MYOT, manage your own trades. Okay? So you get up there, you get a sharp move, you get straight up towards the top of this trading range. Remember, this is the trading range, right? These are the four corners of the trading range, of the tactical trading range, the large one. So once it hits there, it's at that point, you want to be a seller, or you want to see the reaction, because it's possible that you go above the mid Bollinger. I mean, sorry, no, this is not a Bollinger, the mid channel right there, the dotted line. And once you cross over, and if it keeps on staying over that, zigzags around a little bit, it's gonna hit the upper end of this downtrending channel, which is around 2763, which could be a short-term top. My opinion, probably is going to be a short-term top. And you could actually buy, in my opinion, going into a couple of weeks out, you could buy the 2760 S&P calls. I know they're a little bit expensive, but you could buy one of them, or whatever you want to buy. I don't know, and leave it in there. And going in, give yourself some time into early March or mid-March. Because that's where it's going. But the chances are the market's not going to wait around till March to get there. If it wants to get there, it's going to get there right now. If it wants to get here, it's going to get there right now. In hours, if not a day or two. You all know that. I don't need to tell you anymore. The algo HFT black boxes have no patience. They have no memory from day to day. They just look at patterns. They look at numbers. They primarily look at numbers. Because those are all codes, they're right. And they scan the universe of news coming out with any kind of negative words, blah, 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 and this and that and whatever. So that's it. So once it hits there, you are a good solid 100 points from here, right? Which is roughly about 400 points on the Dow from where we are right now tonight. That's it. Now, what's going to happen after that? I have no idea. I have my biases. I think that if the volatility craziness and the vol guys get blasted out, I hope these hedge funds will blow up. I hope they really blow up because they don't deserve. What the heck were they doing shorting volatility at VIX at 9 or 10? We were buying sporadic VIX and just keeping them as hedges, right? And these guys were shorting that at 9 or 10. I don't know. They're smart, right? Yeah, right, smart. That's why they just got like literally JDAM dropped on them to the point where those guys are obliterated. And that's what caused the drama in the markets. All right? And so bottom line is if it breaks here, then, we got room to move and all the lines are drawn. They're going to go all the way up here? No, I don't think so. But who the heck do I know? Maybe this 10% correction was the 10% correction that we saw for the year. If anyone says, no, that's not true, you don't know anything. No, I don't know anything. That's the reason why when the S&P was 1,000, I said it was going to go a lot higher. So that's it, guys. Keep it simple, but keep it very tactical. I'll entertain 1 or 2 questions, and we shall go from there. And keep in mind, we have lots of other earnings coming. NVIDIA, even in the midst of this carnage, huge winner. Twitter, huge winner. More earnings that we played, which are huge winners, Netflix, Facebook, Google, we got hit. Okay? Tesla was up a lot. Came back, started moving, was up. We got moving, the price line got hit because of the market and because Expedia croaked. Now, generally speaking, from previous history, when Expedia has bad numbers, Priceline actually has good numbers because they're competitors. So can Priceline go up 150 points on earnings from these levels? The chances are the stock will go higher. Why? Because it's so far lower than what it was. So let me just scroll through a couple of other charts. So we have a lot of earnings coming. You can play little bits in earnings and they can make back a lot of the money, guys. Don't over-concentrate on just one stock. Don't be like Apple, 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 Apple. And Trent, I'm not just talking about you. I'm just talking in general. Oh, yeah, this and... just put your money, spread them out a little bit. You'll never make money if you don't have a little bit on something that gets bought out the next morning. Don't be putting all your bets on one stock and then just if that stock doesn't go up, all of a sudden, you're like mincemeat. And this Apple phenomena, I mean, look, I like Apple, okay? But as a trading stock, I'm not that enthralled about Apple. Does it move? Sure it does. Is it a mover? I mean, does it move markets? It absolutely does. But to constantly be fixated and obsessed with Apple is like almost like a frigging, I don't know. It's a bad disease, okay? But that doesn't say anything about Apple. I trade Apple too. But you can't be just over-concentrating in one stock, guys. And whoever's doing it, well, it's their wish, whatever they want to do. So let's take a look at some other charts. I'm going to wrap it up. And other people to see this tonight. It's not too bad. It's 10 o'clock. I hope you guys had a good weekend. I finally caught on some sleep. I was exhausted. I was really, I mean, for once in my life, I was so exhausted, it wasn't even funny. And I'm a very energetic guy. I had to do a couple of family things, important stuff. And I wanted to do this webinar. It's so important to go through this stuff. And I think tonight's going to be very helpful to a lot of people that put things in perspective. And I was pissed off at myself at a bunch of times because there's some big trades that I missed by a small margin or I didn't react too quickly. But hey, that's all part of learning. And I did slap myself a couple of times at the end of the week, okay? And many of you should do that too. It does help, trust me. It moves a couple of those neural cortexes, neural networks in your brain, and all of a sudden you feel better. And I'm not kidding around. Feel free to get mad at yourself and feel free to get, don't get sick at yourself. Get mad at yourself. Give yourself a couple of tight slaps on the face. I know it sounds weird. You know, it's almost like a Marine thing to do, right? To take some physical punishment from yourself. Don't let somebody else do that for you. It's not fun because they might not like you and you'll be like mincemeat, done. But I don't do decaf thing. I drink 1 cup of coffee, Mike. You don't know me, okay? I drink 1 cup of coffee in the morning. That's what I do. So decaf and stuff, decaf, you know what we say? That's for wusses, all right? Good luck. Have real coffee. Have real coffee. Just have it black. That's it. Forget this decaf and the lattes and the cup, you know, this. I do like a triple espresso. I mean, that's good. That hits you right there in the face. But don't give me this decaf BS, you know, mild stuff. Just have a real caffeinated coffee. If you're going to have coffee, why decaf it? I mean, seriously. Never had a coffee in your life. So why are you saying decaf? Mike, you're not making sense. You're taking me off track. Focus now. So anyway, bottom line is the U.S. small cap, right? RUT. Very defined chart, guys. Infrastructure plan, one or the other, will benefit U.S. small cap growth. Big believer of that. This, as you can see, guys, is a very important. It's a much more defined pattern. So we're moving in a nice channel. There are some big gaps in front of us, and you can clearly see here off this horrendous lows at of the 14. It actually slipped below 1450, hit 1433 for a few minutes. We are creating a beautiful double bottom. I mean, a W pattern that brings us up again to the downtrend channel, because everything's still on a downtrend on a short-term basis. It's uptrend on a monthly basis, but it's downtrend on a short-term basis. We're looking at around 1534. You can make some real decent money on it, but you got to treat this as a swing trade, or if you're fast on the day trade. I would rather go with the Russell 2000s on a swing trade. That's what worked for me over the years, and I think that works for you guys too. All right. So so this is it's a very defined chart. It's a beautiful chart, and I've structured it very well. So here it was. This was supposed to be the higher low thing, and then of course the big thunderous hit down on Thursday and Friday, and then the massive reversal. So if you want to look at this, so here's your double bottom. Here's your double bottom, and President Trump's infrastructure proposal. In my opinion, it's a very positive proposal. The only thing, very importantly, which he mentioned, and I was like crossing my fingers, this cannot be just public funding, okay? Or else our budget deficit, our federal deficit is so huge, not even funny. Remember, we used to just piss on every single Democrat or Obama, like, oh, they're good spending. Well, if we're going to spend $1.5 trillion in infrastructure, we better have a public-private partnership. What does that mean? That means U.S. corporations. And President Trump mentioned that. I was like, yes, okay? You got to have what some countries have done very successfully. You got to have Wall Street raise big money from private corporations, U.S. individuals. We should all put our money in that. Buy infrastructure bonds. And then the government puts in, let's say, half the money, and the private enterprise, and that's capitalism. But if it's put out that $1.5 trillion is going to come out just from taxpayer money, trust me, this market's not going to like it one bit. All right, that's it. So this chart is very very defined, and the gaps are ahead. You know what the lines are, and you can trade this very nicely. I like the Russell 2000 as swing trades, intraday too sometimes, but like I said, if you have a lot of profits, take it. But in general, it's a swing trade. That's all I got to say. Here's your Nasdaq, which includes biotechs and techs. And gentlemen, we have very, very defined bottoms. Okay, and this is, again, day one. After this big drop here, I'm starting with this line here. Okay, day one, day two, day three, and on day 4, Friday. So follow through worked here too. Very defined chart. We have very, very powerful bottom at around the 6. We actually went below that, by the way. 6,200 level. Remember, we don't trade this. We don't trade futures on this. I mean, we don't trade options on this. Nothing. This is just a direct proxy for knowing what's happening with the Nasdaq, which includes all our all the hardcore high momentum techs, and then of course the biotechs. But the biotechs, we generally don't trade it intraday. We hold them as swings, right? We cost average or we sell when they're higher. Techs, you can trade them all day long and hold them as swings. So this is where we are. Each of these channels were drawn well before things happen, and you can see what happened. So this low here from December of 2017 and multiple, it's a triple bottom. And then this huge hammer reversal on Friday of 6,165, you have a triple bottom, quadruple bottom, going back to November. So this is telling us that techs and biotechs might have found a short-term substantial bottom, like Google at 997 or 1003, as my good friend Trent here mentioned, right? So what can you do? Got to respect it. Quadruple bottom. Does it mean it's going all the way higher? No. It simply means that each of these levels, this was the breakout level back in 2018. The breakout level is 65.45. This chart should be used not for numbers, but for visual structure. If it's moving, if it broke out, this was a very sharp decline. It's a 90-degree type of fall, right? And that's why the channel is drawn like that, the dotted line in here. Here's your downtrend line. And that downtrend, and the reason this line is drawn like this, because this was a inverse megaphone. So the upper end of the megaphone happens to be the downtrend line. Everyone understand that part, right? This is the megaphone pattern, right? There's your megaphone. This is what a megaphone looks like. Or if you hold it upside down, it looks like that. When you're shouting down at somebody, when you're shouting up at somebody, this is what the megaphone looks like. When you're shouting down at somebody, you're holding the megaphone like that. That's what it was. It hit the lower end of the megaphone multiple times, hit the quadruple bottom, and now it's breaking out. So on the most bullish case scenario, it's going to come hit the upper end of the megaphone, which happens to be the downtrend line. So use this as a powerful proxy to see what techs would be doing on the other side. But I'll do the job for you, but what I'm putting out there, just try to understand what it's telling you. It's more of a directional bias map. This is your small cap on a short-term basis, on a daily. And it's looking pretty sweet to me. This shaded area was the previous gap. Right there. Right there, because there's a gap here. And that's where it's going. That's a lot of money, guys. And this was the broad channel it was traveling in. Till it broke down, broke out, broke down, and now it's heading back there. So this is your broad channel you want your RUT to enter. Okay? And that's above like around 15, 16, 15, 17. And the RUTs they move in nice chunks. So that's it. And here's your megaphone again. Upper end of the megaphone happens to be the downtrend line. So guys who actually want to make money, they can trade these numbers. All right? They can trade these numbers. Let's say you didn't get a chance to because you're comatose or you just couldn't look at bed to look at the market. It happens on Friday. Okay? Just, oh my God, I can't take a look at it. Turn the TV off, turn the computers off, take a nice walk. Great. Then come back on Monday, refresh, and do this. So even if you didn't catch the all-time bottom, short-term ultimate bottom at 1433, and it jumped 40 points from there, more than 40 points, then any type of mini pullback or even here you buy because it looks very highly likely given the length of this hammer reversal. Huge. I can't identify a hammer reversal with that type of length, and the length simply means the number of points or billions of dollars that were short covered and bought. That's what a tail is. What is a tail? A tail is not like what your dog has behind it, right? Or your cat, or my dogs and cat have, all right? Or your mouse has, or whatever. A tail is billions of dollars being bought or short covering where they covered and bought that particular asset. That's why it's called this is a long tail hammer reversal. You guys have seen every single time what a long tail hammer reversal has done. I can identify a long tail hammer reversal in this chart. I can. Can you guys? So it has to be respected. Can you guys see anything which mimics this type of movement? This is billions of dollars going in. I can't. So I'm not saying it's going to go all the way up here. All I'm simply saying is you could get a good solid, let me see, 1476. You could, and there was a lot of rejection here, 1517. You got another 30 points here to be taken. Now, if the 30 points are taken right away when the market opens, well, it's too late at that point. You might want to sit back a little bit. Last two things I'll show, very important. And anybody who does not watch and understand tonight's webinar honestly shouldn't be trading on Monday. They shouldn't be trading on Monday. And I'm saying that as a friend, even though, you know, you might not be my friend, but I'm saying that as clue to say trading. Just don't trade on Monday. Let's do this. There's some fantastic articles that I'm putting out there. Scan them before you start your day tomorrow, or if you really want to make any money in the market this week. Very important. I found them to be highly valuable. This is where we are. Okay, so the 533 chart, real quick. Stochastics, despite the fact that we had this big fat type reversals, had a positive, a red candle, and then the reversal on Friday. It had a positive divergence. That means they kept on going higher. That's a good sign. So while all this volatility was going on for the past couple of days, the overall stochastics after the first drop on Monday, this was Monday, Tuesday, Wednesday, Thursday, Friday. Yes, after the big Monday drop, they continued to create higher lows. That's a positive divergence. This is extremely oversold. I have never seen in as far as my memory goes, and I can minus 30 on the MACD. That's what happens when you have that volatility trade blowout. Okay, so I'm going to go back 1 year instead of 6 months and see whether we can identify somewhere minus 30. You see anything? I don't. Let's go back 2 years. Let's go back 3 years. I'm talking about this particular column, the MACD. Nope. Let's go back 5 years. Most it allows me to do. Let's see. Nope. So we've gone back all the way to 2013. We have never seen minus 30 on the MACD. I rest my case. Is the market oversold? Remember, this is a directional bias chart, and the stochastic and the MACD and stuff is telling you what the downward momentum pressure is. Minus 30. Hallelujah. Okay, never seen it, and I just showed it to you. This is good. This, despite all this volatility, the last 3 days, the second half of the week, gentlemen. Look what this. Remember, when these stochastic lines turn, the market inevitably has a short-term rally. That's just the way technicals work. So given that the last 3 days we were going like this, look what was going on with the stochastics. They kept on going higher. Interesting, huh? That's called hidden signals, divergences that are happening within the market for different reasons. Want to find out about it? Like I said, sign up for the advanced coaching sessions. I'll make you an expert on how to read these things. You won't even need me. You'll just look at my alerts or do your own alerts and you'll be like cruising. All right? So that's it. Now, the other one that I want to show you guys is the NIMO. We can actually just see it on that chart, which is the New York Stock Exchange Mcclellan Oscillator. And let's see what's going on with that. Believe it or not, I was pretty exhausted. I normally check it 2 hours after the market closes. I didn't get a chance to do that on Friday. So this is the first time I'm seeing it with you guys. Let's clean out this chart a little bit. First, it's area. Second, it's not a year. We're going to do 6 months. Everything else looks good. Let's change the color scheme. And bingo! We got a picture. Do we? Looks different. Okay. Bottom line is, what you need to be focusing on is your this chart is looking a little bit different. Couple of things here which are positive, which are open to your naked eye. You don't have to think much on this. Let me go 8 months because there's something going on here. I want to show you. Now, saying all this, well, let me finish this one first. Come on, come on, come on. I thought I went 8 months. I gotta go a year because I want to show this part. Okay, I'll go a year. So bottom line is a couple of quick things here. I'm going to do simple brush strokes here. First of all, the NIMO was down to -10. It jumped up. It's now heading towards the overbought level to around 90. That's what I'm talking about, the short-term rally levels that I explained clearly. That short-term rally could be as short as till Wednesday, get a pullback, and then it moves forward. Okay, that's what I'm saying, and that's what I showed you guys on the chart. Then we have this moving higher. This area, okay, all the stochastics have turned, and what's interesting is the MACD has turned. Okay, it was -12, which was extremely low levels, and of these levels you get the buying pressure coming in. So this is moving higher, just the way it did back in August, the way it did it back in March, and you get, and I'll put a more clearer chart tomorrow. This is moving higher. We need the stochastics to turn. And when they turn, you get these things up at 90. When things get overbought, this is a short-term chart. We could be overbought with another 200-300 point rally. We'll be opening up 120 points, right? Because we're up 17 on the E-minis. We'll probably open up 150 on the Dow. So right there, depending on your time frame, we're going to be heading towards overbought levels. Once the RSI gets towards these higher levels, you obviously get the quick selling pressure. But if the market wants to go higher, this NIMO, this red shaded part, will continue to move into the black, from red to black, and the upper end of the Bollinger is around 40. I'll show the chart. It'll give me an idea about the directional bias. And the last thing I want to mention to you guys, okay, and thanks for your patience in listening to that, for your own benefit. Technicals are just one side of the picture. If the market really wants to go crazy, no technicals are going to help you. However, as you clearly saw, through the worst period in the market in God knows how many decades, all right, my charts that I presented followed a certain methodical pattern. Yes, they were rapid. Yes, they were sudden. I don't control the market, but I showed the exact structure of what was going on. And each of these charts that I walked you guys through for the first hour or so of this session clearly validated my point and showed how important and valuable a resource, and I have to say this, clueless trading is. And it doesn't matter whether the Titanic is sinking, rising, falling, going sideways, and you jumping in a lifeboat. These charts are your lifeboats. On that note, have a great evening. We'll see you guys tomorrow. God bless you all. Stay strong, and we make some money. Good night.